As promised earlier in the week, we have the one and only Claudia Salm here. She's going to help us understand the Salm rule, understand economics. If you don't follow her on X or Twitter, it's a must follow if you have any interested in money or economy. It goes macro, Fed, fiscal, creator of the Salm rule, a recession indicator. Please welcome Claudia to the show. How you doing, Claudia?
Great. Happy to be here. Thank you.
Awesome. Awesome. You've been a wonderful follow for so long. I appreciate you saying yes to some stranger on the internet. So thank you for being here this morning.
I'm excited.
Awesome. Awesome. Well, I'm going to go to your pinned tweet, and we're just going to start with this because this was done on August 7th of this year, 2024. It is your pinned tweet, so they can all see this. It's a Bloomberg article, it looks like. And here we go. The U.S. is not in a recession, despite the Salm rule indicator bearing my name saying that it is. That said, the risk of a recession is elevated, strengthening the case for the U.S. Federal Reserve to cut interest rates. Again, I remind you folks, August 7th, that was sent, and we all know what the Fed did in September. So, Claudia, tell us about that tweet.
Right. So back in 2019, I developed what became later known as the Salm rule. So it's a recession indicator based on changes in the unemployment rate. And to put that indicator together, I looked at the historical experience up through 2019. What increases in the unemployment rate only happened in recessions. Now, it was a historical pattern. It's not a law of nature. I didn't, I'm an economist, not a scientist, right? So but it was a very solid pattern. And what it is specifically is that once the unemployment rate has risen a half a percentage point or more relative to its low over the prior 12 months, historically, with a high degree of accuracy, the United States has already been in a recession in the early months, but already in one. It's not a forecast. It's supposed to be an indicator. And that we hit that threshold this summer with the July employment report. The Salm rule, quote unquote, triggered. It just triggered half a percentage point, so it wasn't a big increase, but it was in that range where the Salm rule was saying we're in a recession. And that very day when the news came out at 8:30 a.m., I was on Bloomberg radio and I said, the Salm rule says we're in a recession, but Salm says we're not. Because it's, and this is where this period has been extremely complicated, and our simple rules of thumb have really not been up to the task. And the Salm rule joins a long list of our kind of go-tos. And frankly, what I could do to say that with conviction, data that, again, today we got an update on, was in particular looking at like GDP data, looking at other parts of the economy. Even within the labor market, things were still growing. A recession is about a contraction, and there just were not signs, broadly speaking, that we were in a recession. So the Salm rule, it broke in that it indicated a recession when there was not a recession. And that Bloomberg opinion piece is me explaining, and I had for almost 2 years said this could happen, right? Because there were some very specific disruptions in the labor market due to the post-pandemic. And then we had big increases in the labor supply and immigration. So the article talks about why it is that this simple rule of thumb fell apart. And in the time since we got that information, we've gotten it confirmed again and again that the U.S. is not in a recession. I mean, we learned that in the third quarter, real GDP growth was almost, not quite, but almost 3% at an
it just
annual
came out
rate.
this morning. 2.8 this morning.
That's not a recession.
No, it's really hard to have a recession at nearly 3% real GDP growth. Kudos to you on, again, the rule of thumb. If memory serves, at least through 2019, it was 9 for 9 as an indicator or a pattern.
So since the 1970s, it was perfect in that it only turned on inside of recessions, and it always turned on in a recession. If you go back, there were 2 periods in the late 1960s and the late 1950s. There's an episode where it turns on, then turns off, and like 6 months later, we're in a recession. So there are historically some quote unquote false positives, but it's pretty accurate. But again, it's a pattern. It's not, there's nothing magical about the 0.5%. And what another way that I've seen this underscored is people have wanted to take the Salm rule and apply it to, say, Canada or
Mm,
Australia or other countries or even US states like California or Kansas. And
right.
it you can't really do that, right? The trigger, the actual formula was very much based on the historical pattern, like trying to capture um those break points. And it's but there's a logic to it. I'm not It wasn't just,
Yeah.
just pulling out numbers. Once the US labor market gets some momentum going, it can keep going, right? And then
Yeah.
in a recession, that's a bad direction.
Yeah, again, I'm just, a guy who studied economics and studied the economy for 30 years. Nowhere on your scale. When I look at the Psalm rule, what it always meant to me is it's kind of a rate of change. And to your
Mhm.
point, when you look back at the labor market, when and if it breaks, it takes the elevator. It breaks hard. And that's why
Yeah.
the Psalm rule always made logical sense to me, because it's, to me, it's a rate of change tool. Is that fair, or am I off?
Right. It gets an aspect, maybe even of momentum.
Yeah, there you go.
Not quite.
Momentum.
It's just that with the unemployment rate, we have gone into recessions from very low unemployment rates. I mean, you have to go back to the 1960s when unemployment was like really low in general, but we've had times where we've gone in with very low unemployment rates and we've gone into recessions with relatively high unemployment rates.
True.
So this idea of where it's the change and a recession and a turning point in the business cycle, it's really about some abrupt
Yeah.
change.
I love the
And
idea of
and
momentum. Momentum's a great
yeah.
word. Yeah. And one of the reasons the Psalm world kind of gave a false positive or broke this time, I've heard you talk about. So these are my summary of your words
Mhm.
is really migration, right? We basically messed with the denominator in this analysis, and that it really hadn't happened before. We just had a lot of immigration, and it's really the denominator that changed. Is that fair? Do I understand that correctly?
Well, absolutely the case that the supply of workers changed
Supply,
pretty
yeah.
abruptly. And we saw early in the pandemic, we had millions of workers drop out of the labor force.
Yep.
Not just get fired, but
Just
walk away from work. And then we went into a period of, well, the customers came back a lot faster than the workers. And so we had labor shortages. So there was a period where the unemployment rate was actually pushed down because we were missing workers. And remember, the
correct.
Somme rule is all about changes, right? So I've got the
Hmm.
reference point is an unusually low number because we had workers walk away. And then we had a period, both the immigration into the country was a large and rapid reversal. Like it really had shut down during the pandemic, and then we had a lot of immigration come in all at once. But we also had people come off the sidelines. So we had
True.
prime age working women hit an all-time high for participation. So just in general, we had a great labor market that was bringing workers in. And what happens is it can timing is everything, right? So
Hmm.
we get a big group of workers, they're looking for jobs. The labor market had already kind of cooled off some. We weren't in like the big heat of the labor shortage. And so it just takes time. So you
Mm,
had unemployment rising to some extent just because the jobs were catching up with the workers.
mm,
And when they do, that means we've got even more workers, we can do even more, produce more. That's not a recession, that's a growth spurt
mhm.
in the making. But in a recession you have less demand for workers, and that's why you start piling up in terms of the unemployed. Now, of course, this time has to be complicated, and we have a mix of both. We certainly have seen demand for labor, particularly new entrants to the labor market. Like it's gotten a lot harder to come out of high school or out of college and go find a job. Whereas if you already have a job, the layoff
Mhm.
rates have been really low. So we have a labor market that's not quite doing what it normally does, right? Like you've got kind of the employers seem to have this like we hold on to workers, that's good, but we don't want to hire more. Well, that's not good. And that puts a lot of pressure on the labor market. And it so happened that it came at exactly the time where we had a big group of people coming in and looking for work. So
Yeah.
it's the Somme rule was picking up on the fact that things have softened some. I mean, this is, the Fed picked up on this as well, and that's part of justifying their, getting going with the rate cuts. But it overdid it,
Mm.
right? We got across the half a percentage point threshold in part from these labor supply effects, which frankly aren't recessionary. Now, anytime we have people who are looking for work who don't have work, that's a problem. because
Correct.
they could be out there producing and contributing, but it's a different kind of problem than saying we're on the edge of the cliff falling into the recession.
Yeah. Well, let's talk about really up-to-date jobs numbers. This morning, we got the second of two. We got obviously the JOLTS report earlier in the week, which frankly disappointed to the downside. We got ADP report, which surprised to the upside. We got a big number coming Friday, which I think expectations are still for a positive 100,000.
Mhm.
Any thoughts on what's happening in the labor market now?
We it's unfortunately, it's gonna be tough to get a good read on what's happening in the labor market. We've gone over many months, if not the last few years, through a process of what often gets called normalizing,
Hmm.
right? We had these labor shortages where there was just so much demand for workers and wages were increasing and we were hiring to build back from after the pandemic, and it just wasn't sustainable, right? Like that's not it was tough, frankly, on everybody involved to have that kind of a labor market. So we've seen a gradual moderation. So we have payroll increases month over month that are really pretty similar to where we were before the pandemic, and that was a great labor market.
Mhm.
And the unemployment rate is still right around 4%. Had a period below 4% for the longest stretch since the 1960s. I mean, we broke that during the summer, but I mean, it just really has been good. And yet, the direction is worrisome, or at least
Hmm.
worth keeping an eye on, in that moderation, we haven't seen any signs of it really leveling out, right? It's good that the payrolls are back to about where they were before the pandemic. It's been a little less clear in the monthly data recently if we're gonna kinda hang out there or if it's gonna continue to chip away to the south, and that would be a problem. And in the JOLTS report for this past week, the what was for the month of September, the metric that I remain most concerned about is the hiring rate. And
Hmm.
so that it has gotten back down to levels of about 2014. And that
Oh,
was
okay.
not a good labor market. That's like a 7% unemployment rate labor market. Now, at the same time, the layoff rate, as I mentioned before, has stayed really low. So you
Yeah.
have the labor market's not good. It's not particularly good if you're out there looking for work. It's really pretty good if you have a job. Now, that's not one of those two things is going to, in all likelihood, shift, right? Like employers are either going to be optimistic and want to keep their employees and grow their labor force. So we'll see hiring rate come up, layoff rate stay low, or they'll get to a point where they're like, no, no, we really don't need all these workers, and the layoffs
Right.
will come. Now, from the 1 month, JOLTS was something of a mixed bag. There was some good news on the hiring rate, less good news on layoffs, the vacancies. But in general, we need a little bit more to see if my impression in recent months is we have settled into a pretty good place, but we're bouncing around it. So we have
Okay.
some months that look a little weaker, some months that look a little stronger. Again, I'm concerned until the hiring rate starts coming up in a meaningful way. I think we'll be in that, bouncing around place. But all eyes are on the employment report for October that we'll get on Friday, and it's gonna be a mess in all likelihood. In
Got
that
hurricanes and yeah.
yeah, because we have, 2 hurricanes, Helene and Milton, that were close to the reference week. So that's
Sure.
the everything we know about jobs in the employment report. It comes from the week that includes the 14th, like the pay
Okay.
period that has the 14th of the month. So that's how it's consistent over time. It's actually looking at a week, not the whole month.
Hmm.
And the surveys have different ways that they treat, like, how are you counted if weather has made it not possible for you to work? And then on top of the 2 hurricanes, we also have an ongoing strike at Boeing that fell in the reference period.
Yep.
So that's where the consensus is about a little bit more than 100,000 per
Okay.
for the month. That's not a great number, but there are estimates that behind those the consensus forecasts are estimates of somewhere between 50 to 100,000 of payrolls is knocked off because of the hurricanes and the strike. So if
Okay.
you put that back on, then people are saying, "Oh, we think we're around 200,000." That's great.
That's
That
okay.
would be
Yeah.
right in line with kind of pre-pandemic and right in line with what we think is a good uh, labor market. Now, the ADP data, which comes from different source, and you know conceptually similar, but there's no reason the numbers have to line up. The ADP
Mm.
data didn't really show much of that hurricane Boeing effect. So those numbers look
Okay.
pretty good. They look more like that 200,000 trend. So we'll see. I'm prepared for the payroll numbers in particular to be pretty messy on Friday. I think we understand why that is. The Bureau of Labor Statistics, when it's these kind of issues like hurricanes and strikes, they'll put a notice on the release. So the experts
Mm.
will help us say, yes, weather appears to be affecting payrolls, and yes, here's how many Boeing workers are on strike. So they kind of help make sure everybody's starting out with the same
Yeah.
set of facts as they're debating it. Um, but things like the unemployment rate shouldn't be as affected as much. And there are just other places in the release to kind of go and look for, is this a one-off,
Mm.
or is it weaker, or it could be stronger too, right? Like we
Yeah.
really could see anything on Friday.
Yeah. Any thoughts if 100K is the over under, would you just wild ass guess below or above, or you don't play that game?
So on my Substack, so stay at home macro, so play on my
There you
last name
go.
Som. This week, my piece is on the payroll report, and essentially, I'm at least making the case about why one should think about taking the under, and the under in particular. I think we have a recipe for what could be the first negative payroll print
That's funny.
in a
Yesterday
while.
you put out a tweet about anybody brave enough to take a negative number, and I replied with negative 25,000. That was something you
Yep.
sent out yesterday. So yeah, I think it's going to be pretty messy, and the headline print's going to be negative. But again, to your point, there'll be a bunch of footnotes about why
Mhm.
that's negative.
Yeah.
So
And we have, there are times, like, again, this labor market in the 3 years before the pandemic, great labor market.
mhm.
And we had a lot of month to month volatility and, what the payrolls were. And in fact, in September of 2017, we had a negative print
Hmm,
on the initial. It was revised up some, but it initially printed a little bit
hmm.
below
I forgot
zero.
that.
And September of 2017 was Hurricanes Harvey and Irma.
I
So
forgot
it's
all.
exactly that kind of situation where we can get this extra noise.
Yeah.
And my argument in the post is, even if we have a negative print, it could be entirely consistent with the labor market's growing at the
Right.
pre-recession trend, or the pre-COVID trend. It's just
Right.
we've got this extra noise on top of it. So, but it'll be one of those reports that anybody coming in with a story will find something to help
Yeah,
them tell their story.
I totally agree. I agree. I'm curious, what were your thoughts when you saw that 818,000 adjustment? I think that was 2 months ago when they adjusted the. Were you surprised by that? Was that bigger than you thought? 'Cause that's pretty massive.
It was somewhat higher, but largely in line with the expectations going into that
Mm,
release. We get a sense, the I mean, first of all, I have to say, like, big revisions to me, or just revisions in general, are a sign of the quality of our statistics, and not a sign of evil doing, which is what I often get
me
told
too.
online. But it's the
Yeah.
thing is, the payroll numbers. So it's off of this, the second week of the month is what we're always trying to measure, and we get those data not like 3 weeks later, right? The beginning of the next month. And so, but to do that, the agencies use surveys.
Mhm.
And while it's, tens of thousands of individuals, tens of thousands of businesses, it's still a drop in the bucket relative
Right.
to how many workers and businesses we have in this country. And so we start out with these surveys that are well designed, but they're going to be imprecise because they're surveys. We don't go out every month and do a full census of
Right.
the entire workforce. So, but then over time, when we get to that preliminary estimate of the annual revision, which they put that annual revision in every February, so we're kind of getting a
Mhm.
heads up what, what's going to come in later early in the next year, that the Bureau of Labor Statistics goes to the state unemployment insurance agencies. And that is much more like a census, because an employer does have to report out how many people they have on payroll for these programs. Now, there are other workers that aren't covered by Social Security, and so there's other sources of data that the Bureau of Labor Statistics uses, but that 800,000, that's much more like a census of the workers, and so that's a more accurate. Now, we don't want to wait 6 months to get our first read on the US labor market. So these things all fit together. Now, it is the case that whenever you're in a rough ride period of the economy, especially around turning points, you can get fairly large revisions. And sometimes that can tell you something, right? That the initial survey, not just the survey, but they also, it's really wonky here. They have to do an adjustment for what they call births and deaths
Birth
of
deaths. Yeah.
of companies. And because again, it's not a census at every point in time. They kind of pick a sample of or a sample of businesses to survey. Well, in the survey period, some of them are going to stop being businesses, and some new businesses will come into being, right? So we know that these surveys, they just can't quite get the dynamic aspects of the US economy. So there's a model that kind of adds on and sometimes subtracts off, in this estimate of how many like new companies are being created, new companies are being or current companies are ending. And that had been adding a good bit. And if things start slowing down in the economy, well, you can see how that model might start getting off track. And so then when you bring in this more census-like information, well, it's like, oh, no, actually, we didn't add all those extra jobs. So it makes sense. And yes, this was one of the larger revisions, but you go back and you go back to periods, and it was like early in coming out of the Great Recession was another period. So it kind of makes sense. And it was worrisome, right? If you start having big revisions and you're talking about, oh, we could be in a recession or one could be coming, like that's not a good place to feeling to have. But it doesn't, I mean, it's more information. And it did, as soon as we had that, it has shaved off some, like, it's not that just because you've had down revisions, you're going to have more, but I think it did take, the Fed has said they're thinking about this.
Yeah.
Like when they
Powell said
say
that.
these big numbers, like we saw last month, maybe like they're just a little extra big, right? Kind of shave it off a little bit. So it makes it complicated. And I can understand why people are frustrated with it. And I would love to have the number right out of the gate, but that's not the way this works.
Yeah. Like yourself, they're not even college educated in economics. Would you say that, if they were going to watch one number every week for the job market, is just quite simply on the jobless claims every Thursday? Just watch that. I think we've been trending right around 230-ish. We did have one pop to 255 a couple of weeks ago, but no concern at 230. But if it popped to 300 or 3.25, that's a worrisome sign. Is that what the average American should look at?
I'm not a huge fan of the weekly tracking number. In just in general, I still think if you wanted to track one thing about the US labor market, it'd be the unemployment rate.
Okay.
I mean, I think
And that's
the
today at
easy.
4.1. Is that today?
It's at 4.1. Yeah,
Okay.
for September is at 4.1. Now, I think with claims, it's the same principle applying. Like what I use in the SOM rule is looking at the changes. So I
Correct.
absolutely have been watching the claims, the initial claims data, the continuing claims data. So, people coming on unemployment insurance, people staying on unemployment insurance. There's a lot of, it's administrative data. So, I had people ask me, the SOM rule, I use the unemployment rate. The unemployment rate we get every month, but as you said, claims data we get every week, right? Like, so this could be even faster. And I've had people ask me why I didn't use the claims data. And one aspect of the SOM rule is I wanted it to be simple. It was the design of it was to be used in fiscal policy, to have like Congress use it in recessions. But I said I didn't want to have to put an indicator in for deer season in Michigan, right? Like with the initial claims data, you'll see little notices about adjustments made for various things that have happened, because that's life. I mean, in the state agencies,
Yeah.
they're having to deal with, plant closures and this and that. But it's like that's way more uh information than I wanted to deal with in
Yeah.
the indicator. But it has been, watching I think in particular watching the changes in the claims, I do worry because programs can there are like details to the programs that can make it sometimes hard to compare across long periods of time.
Mm.
So an increase in the initial claims to me is more meaningful than just saying, oh, it crossed some particular threshold.
Okay. So again, a rate of change. Watch
Yeah.
the rate of change or momentum. I think we said earlier makes
Yeah.
total sense. I again, I think Jerome Powell has said this, but again, it's some kind of Fed speak. So I thought you're much more experienced here. Is it fair to say that the Fed, as it currently sits, they're watching labor as priority number one and not inflation? Clearly, a year or two ago, it was inflation, inflation, inflation. Has that rotated or pivoted? Now it's labor they're watching most acutely.
This is absolutely a dual mandate Fed, right? So they are cognizant of both their stable prices, which they've defined as getting inflation to 2%,
Mhm.
and the maximum employment. So basically getting as much employment as we can get while keeping inflation under control. What has shifted for the Fed is not that orientation. Like they have their dual mandate. They've time and again shown a commitment to it, probably in a way that Feds of the past haven't even managed to do, right? The dual
Mhm.
mandate came along later than just the inflation mandate. Um, but what changed is that in the past year, inflation has really stepped aside as a
Mm.
problem. We have moved down. And again, with the GDP numbers today, like we are running inflation at or even maybe a little below the 2% trend. Now, we're not out of the woods, and there's always reinflation risks, and core inflation still has, particularly through the shelter component,
Yep.
is being somewhat stubborn. But in terms of where the concerns are, we've gone as inflation has gotten much closer to 2% and is continuing to move in that direction, right? So like we can see where it's headed.
Mhm.
We have had these concerns come up about the labor market because there's been this moderation and it's gotten to the point where it needs to level out, and it has not convincingly done so. And this summer, in the run up to the first rate cut by the Fed, it was really not clear that the labor market was in a steady place. And that's what
Mm.
the Fed stepped in, and they did a bigger cut than normal, but I take them very much at their word of this recalibration, which essentially in Fed speak is we messed up. Like
Fair.
they should have cut in July. Like given what they knew later, it would have been appropriate to start cutting by 25 basis points in July.
Mm.
They didn't do that. They got some information like 2 days after the July meeting being like, "Oh, maybe you should have cut in July." And
Whoops.
they talked about it, right? So I mean, it's not like they were so far away from it. And then by the time they got to the
Yeah.
September meeting, it's like, well, no, we really cutting in July would have been a good idea, and we should cut in September. So we're just going to gather the two of them up together and then, start down the path. Um, the news since then has been more positive, knock on wood. We've got the employment report will be
Mm.
a important one, but they're now set up to have a more cut by 25 basis points at the meetings and
Yeah.
probably do that for a while until they make a little progress and then hold back and kind of see, do they need to cut more or
Mm.
do they just let it sit where it's at?
One of the things we've heard them clearly say is they want to get less restrictive, right? They want to get back to
Mhm.
neutral, R star, all of this fancy econ speak. I've heard different Fed presidents talk about it being between 3 and 3.5. I think Michelle Bowman is the outlier. She might think it's more like 4. Where, I mean, tell people why the neutral rate is so important in it. And oh, by the way, it's also not really known. It's a best guess.
Right. Well, I didn't even know if I'd call it a best guess. It's just we don't know what it is.
We don't know. Yeah.
But the concept of it is really important. We can argue about the numbers, but the concept. So the idea is, okay, what is the federal funds rate
Mhm.
when the economy is back to normal. When the Fed's action, so what it's chosen as the funds rate, is neither pushing up the economy nor is it pushing it down. I like to talk about it as like the Fed's out of the way.
Okay.
Like there's always going to be a federal funds rate, but it's like the Fed has set their rate to a place where they're happy with what things are at. We're at the dual mandate. There's no reason for them to be trying to smooth things out. I mean so okay, so that's what we're looking for. But what determines the actual number is, what does that economy look like when everything is back to normal and we're at the dual mandate? And one thing I've argued is that, with the really good GDP numbers we've been getting, so we had a lot of strength in the economy. This could be consistent with a neutral rate that's higher, because a strong economy can tolerate a higher interest rate, because when the economy is strong, income growth is strong, right? We can pay those mortgage payments because we have bigger paychecks. So sorry.
It's okay. Drink some water. You're okay.
Oh, goodness. So, right. So but that's where I think sometimes when we talk about the neutral rate as a number, like it's 3.5 or it's 4, we have to, like, what is the context for that? Like, what else? What's GDP? What's debt to GDP? What's inflation? Like, there can be good reasons and bad as to why that neutral rate could be high.
Yeah. One of the things that I've started to share with my audience, and again, this is just one guy who reads a lot of stuff, not a professional like you, but I was trying to answer for my audience, why did mortgage rates basically go up 100 basis points? Why did the 10-year note go up, 60 basis points after the Fed cut 50? And one of the things that I started sharing with the audience in the last 48 hours, maybe 72 hours, is I don't think it's, some kind of conspiracy, to help Biden, the Democrats. I don't think it's any of that. I actually think what might be happening behind the scenes is the bond market, or the smart money, is reducing the odds of a recession, right? Maybe the smart money thought a recession was here or coming, and they obviously know what the Fed would do at that point. They would cut to stimulate the economy. And maybe what the bond market is saying, to your point, the neutral rate's higher. We don't have much more to go. And if that's the case, that would take all the long end higher. Am I all wet, or is that possible?
No, I think that's another really important angle to bring up on it. And if you think about before the Fed cut, things were starting to look a little dicey in terms of the economy. And we also have this very unusual situation that we were set up for a cutting cycle, right? Inflation had come down without a recession, which I always said we could have this, but this was unusual. And so now we have a Fed that inflation's come down, and the Fed's like, we need to start cutting. And people are like, well, you don't need to cut.
Yeah.
And I'm like, well, yeah, they do, because they have this thing called the dual mandate. And if they keep sitting on top of the economy, the other side of it will collapse. But so you had this mix, I think, of the market pricing for the Fed's rate path, of people like me who are saying the Fed needs to just get out of the way. Like we're coming to the soft landing. It's time. They're restrictive. Look at mortgage, or like look at interest rate sensitive sectors like autos, like housing. You can see that the rates are having an effect. So it's time for the Fed to cut. But then you also have people who are like, the end is nigh, and they're going to be a recession, and then they'll be cutting, because what got priced in looked like a soft landing Fed path. Right? Like if we really were to go into a recession, we're talking hundreds of basis points out of the Fed funds, not like
no question
50, 25 here. I mean, like this.
Hundreds.
So you have you have a mixture. Whenever we look at the market pricing, it's like you have a mixture of narratives underneath it. And if one piece starts to unravel, and I think the recession piece really unraveled quite a bit. I mean, it may still come back, things repeat, but that coming out is saying, hey, if we avoid a recession, that's avoiding some real scarring, and it's avoiding the, the chance of going back to the zero lower bound. I mean,
Yeah.
if you watch Europe, and they're not in that dire of a place, but given their growth path and where they're at, those risks of having low rates again because of weakness are much more
Much
pronounced
higher.
still
Yeah,
than
much
they
higher.
are in the US. And so, that strength piece, yeah, I think about the stronger economy can support the higher rates, but you're absolutely right. The other part of the stronger economy is we have avoided a recession
So
that pulls
so
us down.
so I might be onto something because again, my audience is
Yeah.
definitely very real estate focused, and a lot of people are going, "Why are rates up 100 basis points?" And again, I don't think it's a conspiracy. I just think it's a smart money going. You know what? We may have this no landing scenario, 2.8% GDP growth.
Yeah.
Unemployment. I don't know, below 4.5. It's not a terrible economy.
Yeah, I think there's some pieces, like there's just a lot of uncertainty,
Mhm.
right? Because again, this while I kind of poo-poo, and I mean I love Fed Chair Powell, whenever he gets asked about the neutral rate, he like just hems and haws, like, and it's like he's the one everybody wants to know what he thinks that number is. He is not going to say it out loud. And
Yeah,
he has an opinion
you're
on
not
it, but
gonna
he's going to
say
say
it.
it.
No.
So, but it is important, right? Markets are making
Mhm.
bets and putting money
Yeah,
on where our interest rate's going to be a year from now, 2 years from now, 10 years from now,
correct.
right? So
Exactly.
like that is just not a theoretical construct for someone putting money in. And so you're trying to make these judgments in a just wildly unprecedented, unusual setup coming out of the last 4.5 years. We have in the US what looks like could be a productivity boom, potentially higher trend growth. We've had higher population growth that isn't totally well measured, but it's clearly in some of our numbers. And it's like, and you're trying, and then you have a Fed that is dealing with like what's the paradigm here,
Yeah.
and they're tracing out with data, and they're not giving a lot of guidance because they've gone into this hyper data driven, like we're just going to put our head down, which I think I understand why they're doing it, but I can also understand why it like really creates some market volatility because markets are trying to filter data the way the Fed filters it, and it's just really tough. And then you do add on top of it, it's an election, and
Yeah.
fiscal has been there's all this uncertainty, has been growing uncertainty about how like the fiscal position of the US. And is that a problem? At what point could it be a problem in markets? And then you have candidates who clearly like neither of them really has a plan to rein it in.
No, there'd be a
Which
lot of spending.
I don't necessarily think is a bad, like, into the kind of I am not a pro austerity person, but then you just there's so much uncertainty.
Yeah.
I mean, honestly, I'm pretty impressed markets hold it together because like this has been layer upon layer of uncertainty. And then what they're trying to deduce is a pretty complicated, like where like the
Yeah.
neutral rate is the sum. It really reflects where we end up, and that forecast is harder than
Yeah,
ever
to
to
me
make.
to me, it's being pulled up. I think that's exactly what's happening. The bond market's a forward indicator of what's going on. So I think the neutral
Mhm.
rate is the guess or the estimate or the prediction is it's not 3, it's probably closer to 4. And I think that's what happened. I don't think it's some mysterious plan behind the scenes. I just think the markets are saying we can handle higher rates, which is interesting. Back to the labor market.
Mhm.
Again, something else I'm sharing with my audience is, I think the labor market, as we exit 2024 is not the same labor market as 2019 structurally, right? 2019, everybody went to the office. 2025, not everybody goes to the office. 2025,
Mhm.
according to some research, there's 24 million solopreneurs doing content creation, right? Like we're doing here. Didn't really happen in 2019. So one of the things I think about all these models that economists have is they're just out of date for the new economy. I think the economy is just structurally different, heading into 2025 than it was pre-pandemic. And I don't know that the models have caught up.
Right. Well, I think oh, you froze there for a minute.
Oh,
Did you?
nope. Nope, you're here.
Yeah, okay,
Hi.
here. Yeah, so this right, there's always this balancing act of trying to put models and frameworks together and then go, take reality to them, right? And I tend as an economist to live in the data space,
Mhm.
right? So and be very empirical, and that has served me well during this cycle because it can free you up from some of the vestiges of the model,
Mm.
right? Because you can have new kinds of data, new kinds of relationships. It can be a more flexible. um, you always have to have those models and guiding principles, like you said, you're comparing now to before, right? So that you have
Right.
something to ground it with. The One of the aspects of the labor market, okay, like broadly speaking, that I think is pretty exciting is we saw early on in the pandemic a real surge in business applications.
Yeah,
So
exactly.
sole proprietors, so small
Yep.
businesses, some with or without employees. I was one of those. I became an independent economist in
Yep.
2020. So uh, partly by duress, but like did I was part of that movement. But what we saw over time is those application rates have stayed high. Not
Mm.
as high, right? Like settled down some, but nothing like before
Oh,
the
very
pandemic.
different.
And one
Yeah.
of the pieces we had really seen a slowdown in productivity growth before for several years before the pandemic, even actually starting before the Great Recession. And one feature that economists had established looking at the data on businesses, the smaller businesses, is they were aging. Right, we
Mm.
just didn't have this dynamism, and it's the small, young companies that are the big growth drivers because, if they hit the lottery, they're gonna bring in grow and become. And so it was we were losing that because you just didn't have the business applications. So it's really hard to tell how much staying power that, pickup has had, but that is huge, potentially huge in terms of keeping the productivity growth that we've seen. And I also think the technology, like work from home, other kinds that have been able to bring people into the workforce who might not have necessarily been
Yeah.
able to before. Like disabled workers have had an all-time high labor force participation. More recently, working with or women with young children, so groups that required some degree of flexibility with their work
Mhm.
time have technology has helped for many to do that. So that we've seen some real benefits in terms of productivity growth in recent years, and the holy grail is, do we keep that going? Because even a quarter percentage point on trend growth,
Yeah.
like that adds up.
No,
And
exactly. Yeah. So I think that is definitely something. Again, when you look at numbers of about solopreneurs and social media, this or that, there's tens of millions of people doing this now and being paid. So I just think that's a structural change that will come out in the wash later. I guess I want to go
Mhm.
back to something that I shared with my audience. I think that when was that Jackson Hole speech? Was that 21 or 22 when he said, "I'm basically going to start raising rates"? Was that 21?
2022 is his there will be pain.
There will be pain. Yeah. So let's go back to
Yes.
22. One of the things that I told my audience way back then, so this is going back, is I believe that Jerome Powell was on a mission to break the Fed put. I haven't talked with my audience this for the last year or so, but I'm just curious. When he said there will be pain, that infamous 6-minute speech or whatever it was, do you think Powell had a vision of finally breaking the Fed put, where the Fed's yanked by the market? Do you think that's true or not really?
So the Fed has a complicated relationship with the market in that the Fed so the Fed's mandate is inflation and employment, right?
Correct.
So these are in the quote unquote real economy. Okay, but the way the Fed reaches the real economy is through financial markets. Right? The
True.
Fed's tool is an interest rate or some, kind of pushing around on interest rates. And so and the federal funds rate, like, no business or person borrows from the Fed, right? So it has to end
No,
up in one
exactly.
of the market rates, and it often ends up, the like the the 40-year mortgage rate, like some of the credit, like things that are longer term, like the 10-year treasury is a much more of an anchor
Mhm.
for the kind of market rates than the Fed funds rate. Right. So
Correct.
there is this dance of like the Fed needs to like, because they're working through the markets, they need to have a sense of what are the like, and we've certainly had cases recent where, the Fed will say the Fed is being restrictive, but you
Mhm.
can look at some measures of financial conditions, particularly more recently if you pulled in measures of like stock prices,
Mhm.
and it'd be like these are not restrictive, right? Like these look great. So it is this kind of trying to figure out what, is are the financial conditions where the Fed wants them to be to in service of that dual mandate. And again, there are so many links in that chain that it gets pretty complicated. The other piece, the Fed has been very focused on, maybe sometimes too focused, is they don't want to surprise the markets.
Right.
So there's an aspect of whether it's the Fed caving to markets, there can often be this dance of like the Fed getting the markets to expect what the Fed is going to do.
Mhm.
And it's always fun when some important piece of information, like before the September FOMC meeting, happens during the blackout, and we go into the meeting with everyone being like, oh, they're going to cut 25. And then you have, Fed Governor Waller, who clearly had the job of going out there to signal 50 and managed to signal 25. Right. Like, and so then
Yeah.
you have to bring in the big guns of the Wall Street Journal to be
Whoops.
like, no, no, no. Like, actually, he meant to say 50. And so, like that was
Good old Nick
absolutely
T. Nick T. Yes.
yes.
That's wild.
But yeah, I mean, gosh. So the Fed, like, and I get it in principle. I understand what they're trying to do. That was really messy. But at the end of the day, you need to do the right policy. And I
Mm.
I was on board with, and I had not only said I thought there was a good case for 50, I also was out there saying the Fed would cut by 50.
Nice.
Which, I mean, I'm sitting on CNBC right as it's announced and being like, well, let's see, because I'm on like multiple panels of the only economist here who thinks 50, and it's just like, oh my gosh,
Oh,
they're
yeah, I think it
gonna,
was like 9% or something, some very single digit
yeah.
number. Thought
But
50,
but
so
it
congratulations.
was very much listening. I mean, I had strongly felt like the case was there for 50. Like I think they had dragged their feet and it was time to get
Mm.
going. And I take very seriously signs of momentum. Like once you lose the labor market, I mean, the Fed does not have the tools to stop a recession when a recession has started. Right?
Correct. Yeah.
They can limit the damage. They can, but their most powerful is ahead
Yeah.
of the
Ahead of the
the
curve.
mess. And so I mean, I felt it pretty strongly. But listening to like Nick Timrose's article, like some of the, bringing in like heavy hitters who I learned monetary policy from at the Fed, being like, yeah, there's a case for 50.
For
And I was like,
50.
oh wow. It's like I'm not just out there. It's like we're really gonna do this.
Yeah,
Um,
good for you.
but
That's
but
awesome.
it shouldn't. I mean, I've often said, well, like I left the Fed to work on fiscal policy. That was because of the Somme rule. But I have spent a lot of time talking about the Fed since then, because what I realized is outside of the Fed, like there's not, especially like policy economists who understand the Fed, can explain it. I think in particular, I have a lot of background with the dual mandate aspect. And having worked for these, I
Sure.
mean, I worked for Powell was the third chair that I worked for. So like, I have a sense of the organization. And yet it has always bothered me that my what I call my Fed decoder ring is
Mhm.
worth money. Right? Like it's a public institution. I
Right.
shouldn't, because I know the secret meaning of recalibrate. And like I knew it's like if he was gonna get, and I had written in the Substack, that's how they'd frame it, as recalibrate, because it
Right.
was really clear Jay wanted to cut 50. And I'm like, okay, what is the lightest touch way to get the votes for 50? And that's,
And
I mean, that was the lightest touch. And it was the most appropriate, because say, oh, we're worried about a recession would have looked pretty silly
right. Yeah.
after the
What
fact.
yeah.
Um, so, but again, it's just this was like from having worked there over a decade, I absorbed this kind of stuff. But like given how important the Fed is in markets,
Mhm.
it really would be beneficial if all market participants had that understanding,
Right.
right? Like it shouldn't be this kind of guessing game. But that, I mean, that's just the way, the Fed's just one piece of markets.
Yep.
There's always, experts have to filter through a lot of noise, but And I guess I enjoy doing it. So
Yeah, you're having fun. You're very good at it, obviously, being one of, I don't know, a handful of folks call for 50 and get it. I guess I'll ask you about your thoughts for the rest of the year. There's obviously 2 Fed meetings. One is next week, I think, one in December. Are you in the camp of they're just going to tinker and a quarter and a quarter? Do you think 1? Do you think 0? Where do you think the rest of the year?
I think they're set up for 25 basis point cuts at the next 4 meetings. Like that
The
would be
next
my
4 meetings.
baseline. The 4. They take 100 basis points out, and then they kinda
So we're
wait and
at
see. So that would
3.75?
take you to January and March. Yeah, and then
Okay.
and then I think
And that
after
would
that point, you can say, "Are we getting close to neutral?" Or, like, I think
yeah,
they've got another 100 basis points, but there's a lot of data between now and next March, so
sure.
I don't wanna say that with any certainty. They are it is very hard to come up with a constellation of data this week that would take them off of the 25 basis point cut
Okay.
next week. Now, if we get some really strong data on with the jobs report, I think the conversation will come back up again about, well, we could pause in December and not cut. I think Powell's baseline, and he seems to be pretty good at getting his way. His baseline
Mm,
would be to just do 2 more 20, like do the 25 in
yeah,
November, the 25 in December. They're gonna have the data scene is gonna be pretty messy between,
sure.
like, the jobs report will get weighed down probably because of the hurricanes this Friday, but then next month when that reverses,
Right.
it'll pop it up. So things are just gonna be a little messy. So I would imagine if they can be boring and just
Mhm.
do 25, 25, they will. But if the data were, again, if they were really strong on Friday and like subsequent data, then maybe, there's a case to take a pause in December, and we could get some pretty negative data back on the labor market. Even on Friday, if the unemployment rate moves up notably, and that's not a place you should see the weather effects, well, then there's that question mark about how solid is the labor market, and then you could potentially see a 50 in December. I don't think they'll move that quick to it, but I'm not sure we're done with the 50s, right?
Okay.
Like it
Yeah.
could happen, but like I said, my base case is we've got about another 100 basis points in 25 basis point increments, chop them away, and then pick their head up and look around, and hopefully, if the world isn't turned
Yeah.
upside down, next week, they'll we might
There you
be
go.
not be that far off of neutral.
Yeah, I think another 100 basis points gets us roughly to 3.75. I think that's where all the discussions are. Is like, hey, is it this? Is it that? I think that's where you really get fed discussions. Claudia, this has been an amazing conversation. I appreciate you giving us nearly an hour. We obviously have your
Mhm.
Twitter handle here at Claudia_Psalm, but it sounds like you have a Substack. Can you tell us what that is again?
Yeah, so the Substack is Stay at Home Macro, and so Sam, last name, and I write about weekly, and it's Fed and then just macro data, labor markets, all kinds of various things.
Folks, you got to give her a follow. Check out her Substack. Again, she was one of the handful of people that called the 50 early. That deserves some respect and notice. Again, we're looking at another 100. I think that makes complete sense. Claudia, you're amazing. Take care.
Great. Thank you so much. Okay.
Sure.
All right.